Good afternoon, everybody. My name is Julian, for those that don't know, and I just wanted to make a quick video for my audience on how to calculate your mortgage loan or vehicle loan and see the total amount of interest that you're paying on the loan, on the life of the loan, and just to see the different various monthly payments and just a plethora of information that I'm basically just trying to explain to you over a tool called Microsoft Excel. I'm going to just do a quick scenario that I feel like it will be very beneficial towards new homeowners, people that are looking to buy a home. It won't take that long, so I'm going to go ahead and get started. All right, so let's just say you are looking for a home and you need $200,000 to purchase your home, obviously based on credit score. It varies with your interest rate that you're getting. So we're going to go ahead and build a table that basically explains the amount of interest that we're going to be paying and how much is going towards the principal per payment. And I want to break it down for you so that you could do this at home. Sometimes, if you want to go to Microsoft Excel, you could just download it. It does cost money. Usually if you're a student, you get it for free. Or Google, I believe, offers it, but there are some different kinks as far as making adjustments on the table itself with different software like Google. So let's go ahead and start. So we need our annual interest rate. And then our monthly interest rate. And I'll explain everything as we go. Number of periods and the amount of the loan and the monthly payment. And then we're building another table down here. Just trying to get everything organized. Monthly. Towards interest. Towards principal. Ending balance. So this is how the table goes. So the monthly interest rate, let's just go with a 6% annual interest rate. All right. Now for the monthly interest rate, we need to divide 6% by the total amount of months in the year. And let's just say we're going to get a loan that's let's do 12 times a 30-year loan. $360 months. Amount of the loan, let's get a $200,000 loan. Sometimes when you buy a house, some banks want 20% down, and if you have a $250,000 house and you could put 50 down, finance the rest, this is what it'll look like. And then this is how we calculate our payments. And how we calculate our payments is going by the rate, by the number of periods, 360 months, by the present value of the loan. So this is what our monthly payments are going to look like. All right, a monthly payment with a 6% interest rate, monthly interest, dividing it by 12 with the number of months in the loan. This is a 30-year loan. 30 times 12 is 360. Present value of the loan is 200,000. Performing our calculations, we end up with a monthly payment of $1,199.10. Now, with that information, we're going to break it down even more in interest, just so we could see the data a little bit better. This is the monthly payments. And if you could see, there's like a little bit of guidance as I bring this down. So we're going to stop at 360. $360. All right, and it's going to come all the way down. Perfect. All right, the beginning principal is of course $200,000. So this is saying that this is our first month payment. The beginning principal is $200,000 with our monthly payment of $1,199.10. How much is actually going towards interest and how much is going towards the principal? Well, the amount that's going towards interest would be calculated like this, times 6% divided by 12. So now to calculate how much is going towards the principal on the first month's payment, you're going to add your payment plus the amount that's going towards interest, which means that on the first month of the loan, the first month on the life of the loan, you only paid $199.10 towards your principal because $1,000 of your first month's payment went towards interest. It gets more interesting. Just to highlight the data. Make it pretty. Monthly. All right. Drag this down. Oh no, you got to do a function here to lock it in. Once you could lock that in, brings that down. This you need to lock in with the interest rate. You bring this down and it solves. And then you bring this down. And then this should follow. Okay, cool. So, and once we get our second month's payments, we could just drag this down and it'll solve it for, wait, what just happened? Hold on real quick. All right. What are you doing? It's messing up on me. Sometimes you got to mess with it because it's very sensitive. All right. Perfect. It did it. So it performed every calculation for every single monthly payment, and I want you to see something. So as the months go on with the loan, you're going to see an inverse relationship with how much is going towards interest and how much is going towards principal. As the life of the loan exists, the amount towards interest decreases. If you look at the first month, look at how much is towards interest, look at how much is towards principal. Now, if we go towards the end of the loan, look at how much is now at the 360th month is going towards the principal, and look at how much you're paying in interest. Only $5.97 as compared to $1,000. So for the first couple years of the loan, you're not even, look, on the 97th month of the loan, you've only put $25,000 towards principal. Now, depending on your personal financial situation, obviously it varies, but this just goes to say that just because you signed a 30-year loan does not mean you got the better deal, because let's look at some other information. Look at how much interest was paid on that loan. You pulled out a $200,000 loan and you had to pay $226,000 plus the principal. Total, you pulled out a 6% 30-year loan with the present value of $200,000. Over 30 years, you paid $226,000 plus the principal. So in total, $426,686.38. It's a lot of money. Now, your credit score does come into play. So let's just say I had a 770 and I locked in a good interest rate, 3%. So if you have a good credit score, maybe this doesn't sound like a bad idea. But as you have a shorter interest, or if you have a shorter loan, you're paying more monthly payments towards the principal, which means you'll be paying less in interest. So that's why some people lock in 15-year mortgages. But yeah, I just wanted to show you all this just so, you could go and do your own finances whenever you go shopping and see what the cost of the money is that you're going to be borrowing. But I hope this video was beneficial, and I'll be making some more content like this throughout the time. So thank you.